Good evening, esteemed participants. My name is Ali Mortazavi, and as the head of training and education at Ranta, it's my pleasure to welcome you to our webinar on mastering risk management today. In today's session, we will delve into the essential strategies that underpin sound risk management, an area often overlooked, yet fundamental to sustainable success in trading. Much like the nuanced approach of an experienced chess player, effective risk management requires foresight, discipline, and an acute understanding of the delicate balance between risk and reward. We will unpack the risk assessment, learn to navigate the unexpected, and devise tactics to protect your capital, akin to how an architect engineers safeguards into a structure and allowing it to withstand unforeseen calamities. So whether you are a novice trader or seasoned in the art of the financial markets, the insights shared today will be beacon guiding your journey through the seas of trading. So let's embark on this journey together, and with the goal of not just surviving but thriving in the world of Forex. Perfect. So here you can see the expected outcomes you can get from this webinar. Let's outline the core outcomes we aim to achieve today. First, we will delve into the essential of risk in Forex trading. Here we will define what risk really means in the volatile world of Forex and illustrate it with real-world examples. And this foundational knowledge sets the stage for everything that follows. And next, we dive into risk management techniques. This segment is about equipping you with practical tools and strategies such as effective position sizing and the strategic use of stop loss orders. We will explore how these techniques are applied in real trading scenarios, enhancing your ability to manage risk. And then we examine the synergy of trading strategy and risk management. This part is crucial as it reveals how a well-crafted trading strategy is intertwined with and complemented by sound risk management principles. Understanding this synergy is key to long-term trading success. And finally, we focus on trading expectancy and the strategy assessment. Here, you will learn to calculate trading expectancy, which might be new term to you, but it's really vital and helpful in trading. And you will learn how to use it as a powerful tool to assess and refine your trading strategies. And this knowledge enables you to make more informed strategic trading decisions. So in summary, today's webinar is about empowering you with strategic insights and practical tools for advanced risk management in Forex trading. Our goal is to transform your approach to risk, turning it into a strategic advantage in the Forex market. So before we dive in, let's briefly talk about Ranta. We are committed to providing top-tier services and building lasting relationships with our clients. Our focus is not just on trading, but on empowering traders through education. And it's important to remember that trading involves risk, so the contents we discuss today should not be taken as direct investment advice in any kind. Always consider your personal circumstances and seek independent advice if necessary. So we thought that because actually the CFDs products are really risky products. Okay, so without any further ado, let's jump on our webinar today. Let me check if we have any new joiner. Please let me know if you can hear me and can see my screen very well. Then after the confirmation, I will start shortly. Very well. Okay, thank you so much for your confirmation, guys. Let's just jump on the title. Okay, the first thing is that what uh, is risk in financial trading? As its core, risk in forex trading is about the potential for financial loss. It's an inherent aspect of trading, much like the ebb and flow of tides. And whether you are a seasoned trader or just starting out, understanding this risk is not just important, it's indispensable for sure. So let's consider the factors that influence risk. First, there is the market volatility, like the unpredictable currents of the ocean. Market volatility can shift direction swiftly, uh, often without warning. And this volatility is driven by various factors, including economic indicators like GDP reports, employment data, and interest rate decisions. And then there are geopolitical events. These are your storms at sea, political upheaval and unexpected election result, or even a global crisis can send shockwaves through the market. Right now, we see the tension and war in Middle East, for example, and before that, the war of Ukraine. So these are the factors that can for sure impact the financial markets, causing significant fluctuations in currency values. Uh, Take a look at these charts here. These, let's say, components of the risk to define it very well. We see how a major geopolitical event caused dramatic shifts in a particular currency pair. Notice the rapid spikes and drops. Uh, that's the risk materializing in real time. So, as we embark on this journey through the world of forex trading, remember these key takeaways. A risk is an unavoidable companion in our trading endeavors. But with understanding and the right tools, we can navigate these waters, turning risk into opportunity and leading to sustainable success in the forex market. Ladies and gentlemen, as we move forward, let's delve into the critical realm of risk management in forex trading. It's not just a tool, it's a vital discipline that separates the seasoned traders from the novices, the winners from the losers. So here you see, let's say, a risk management. What does it really mean in the context of forex trading? At its essence, it's a systematic approach. It's about identifying the risks that loom on the horizon, analyzing their potential impacts on your trading strategy, and then crucially taking steps to mitigate those risks. And it's about being prepared, staying ahead of the game. So now let's break down the core elements. First, there is the identification of potential risks. This is your radar system scanning for anything that might disrupt your trading journey. Then comes the analysis. This is where you gauge the severity of these risks, understanding how they could affect your positions, and finally, the implementation of mitigation measures. This is where you take action, employing strategies to shield your investment from those identified threats. So take a look at this flowchart here. It simplifies the risk management process, showing you a clear path from identification to mitigation. And it's a roadmap for navigating the often turbulent forex market. So why is risk management so vital? It's about protection, protecting your trading capital from unexpected market shifts, and is about making informed strategic decisions rather than reacting impulsively to market changes. And perhaps most importantly, it's about discipline. Risk management is the discipline that can ensure your long-term profitability in the Forex market. And it's not just about surviving the market's ups and downs, it's about thriving at them. As we delve deeper into the intricacies of risk management in Forex trading, let's examine the three fundamental components that form the bedrock of any robust risk management strategy. Firstly, we have a risk assessment. This is your early warning system. It's about vigilance, scanning the Forex market for potential risks, and think of it as a seasoned captain scanning the horizon for storms. In trading, guys, these storms could be anything from sudden shifts in market sentiment to major economic announcements. Effective risk assessment involves not just recognizing these potential risks, but also understanding the context in which they appear, such as current market trends, historical data, or let's say the geopolitical landscapes. So next we have the risk tolerance. This is deeply personal and varies from trader to trader. It's about knowing how much turbulence you can handle before you start to feel uncomfortable. Are you the kind of trader who's comfortable riding out major market waves, or do you prefer calmer, more predictable waters? Your risk tolerance is influenced by several factors: your trading experience, the size of your trading capital, and also your overall financial goals. That we talked about in our previous webinar in great nuances. It's about aligning your trading strategy with your comfort zone, ensuring you're not taking on more risk than you can handle. And the last but not least, we come to mitigate or mitigation strategies. These are your tools and techniques to reduce the risks you've identified in line with your risk tolerance. And this could mean setting stop loss orders to limit potential losses, diversifying your trades across different currency pairs to spread the risk, or carefully calculating your position size to ensure you're not overexposed on any single trade. And effective mitigation strategies are about taking proactive steps to protect your trading capital. So as I showed you in the previous diagram there, elegantly illustrates how these three components, risk assessment, risk tolerance, and mitigation strategies interconnect and support each other. And it's a dynamic, ongoing process where each component feeds into and informs the others, creating a comprehensive risk management system. In summary, effective risk management in Forex trading is a combination of accurate risk assessment and understanding your personal risk tolerance, and also implementing robust mitigation strategies. It's about being prepared, staying informed, and acting prudently. And master these components, and you position yourself not just to survive in the Forex market, but to thrive. So trading risk comes in various forms: market risk, liquidity risk, and geopolitical or let's say interest rate and swap risks, to name a few. And market risk is the risk of losses due to market movements, while liquidity risk involves the risk that you may not be able to exit a position at the desired price. So we have to have a prediction about all of this may happen. Geopolitical risk, or let's say here, let's talk about interest rates and swap risk. This is the risk that changes in interest rates will affect currency values. It can come in terms of swaps. You really need to get yourself prepared to have a mitigation strategies to face any of these risks. For example, for market risk, you need to use stop loss orders, hedging strategies, or staying informed about market events by reading or reviewing economic calendar every day. And here for liquidity risk, you really need to get yourself prepared by trading major currency pairs, which typically have higher liquidity. You can be assured that, and in that case, you will be able to avoid any trading during off-peak hours. That can be very, very simple mitigation strategies. And also about the interest rate swaps, you have to, as a forex trader, monitor central bank communications and swaps of your broker as well on the website. For example, on Arante's website, you can find the swap rates updated in real time. So in that, it will give you the ability to use hedging techniques to protect your account and be prepared for that. And also, here are the other types of risks. It's really vital to know as the first step to identify the risk, the risk that let's say will be associated with our trading experience, because in case that you know these types of risk, then you can prepare your plan and you can get ready to face it. Here you see the leverage risk, we have geopolitical risk, and we have psychological risk, which is also very important. And it means emotional responses can lead to over trading, revenge trading, or deviating from a trading plan. And these are the, let's say, some negative aspects of the psychological risk that we may face in our trading journeys, especially if we follow trading very seriously. So we really need to hire some mitigation strategies to face this and to mitigate this. For example, we can name developing a disciplined trading approach, adhering to a well-tested trading plan, or to face the leverage risk. We really need to use leverage cautiously. We should control our greed, our emotion to stand on top of the markets, and so we have to control ourselves to prevent using a very, very high leverage blindly, and we need to understand the implication of leverage trading first. So in our journey through the nuances of risk management in forex trading, let's now turn our focus to some specific techniques that can be employed to mitigate risk. And after identifying the risk, so we need to find the right approach to mitigate it. These tools are not just about defense, but about enabling smart, informed trading decisions. Let's start with diversification. The old adage, don't put all your eggs in one basket, holds through in forex trading. Yes, let me find my laser pointer here. Okay, very well. So by spreading your investments across different currency pairs or even markets, you reduce the impact of a loss in any one trade. For instance, a trader might invest in a mix of major pair like Euro USD and USD JPY. along with some minor pairs like AUD and CT to balance the risk. Another example is combining forex trades with other assets like commodities or indices, providing a hedge against currency-specific fluctuations. Also, position sizing is on the corner. This is about calibrating the size of your trade to match your risk tolerance. Say you have a 10,000 account and you are comfortable risking 1% per trade. That means your maximum loss per trade should be $100. If your stop loss is set 50 pips away of your entry, the position size should be 2 micro lots somehow, or 0.02. Another example is a more aggressive strategy where a trader risks 5% per trade with a tighter stop loss at 20 pips. The position size can be increased accordingly. So we will get into the great angle of details about the position sizing later in this session, guys. However, the third one, now let's consider stop loss and trailing a stop loss order. This is another technique to apply risk management on our trade. These are crucial for managing ongoing trades. A stop loss order might be set at a point where your trade hypothesis is invalidated, like 30 pips below your entry point. A trailing stop loss, on the other hand, moves with your trade's favorable price movements. For instance, if you trade again, your trade, let's say, gains 40 pips, the trailing stop loss could move up to lock in some of those gains while still giving the trade room to grow. We explained the stop loss orders and trailing stop loss in our previous webinars for sure. Please make sure you can access to those webinars through our website, the webinar Arantes webinar webpage, and then you can just watch it again. Or in case you missed that, you can just watch it there, and you can find a lot of great details about the crafting a winning trading strategy. Okay, lastly, let's talk about partial take profit. This technique allows you to capture profit while leaving a portion of your trade open to benefit from potential further favorable movements. Imagine your trade is 50 pips in profit, and you could take profit on half of your position, securing those gains, while the remaining half continues to ride the market trend. So we try to demonstrate how each of these techniques can be applied in a real trading scenarios, highlighting their effectiveness in different market conditions. In a sense, these techniques, diversification, position sizing, stop loss or trailing a stop loss, and partial take profit, are not just risk management tools. They are your strategies for informed, calculated, and successful trading in forex market. Okay, here we have position sizing. A critical component of risk management in forex trading is the art and science of determining the optimal amount of currency to buy or sell in a trade. It's a balancing act between maximizing potential returns and minimizing risk, tailored to align with your risk tolerance and trading capital. Let's break down the formula for position sizing and its key components. The formula is position. You can see you can see the let's say the formula here. It's the account size multiplies a risk per trade divided by a stop loss in pips. This is a very, very simple formula. Let me just explain the components here. The account size, this is your trading capital. Yes, this is your trading capital, the total amount of money you have available for trading. And the risk per trade means the percentage of your account size you're willing to risk in a single trade, and it's a reflection of your risk tolerance. Having a stop loss in order to determine the right size of the position is vital, is essential. The stop loss in pips, this is the distance in pips. You set your stop loss order away from your entry point. It defines the point where your trade idea is invalidated if the price reaches that level. In conclusion, position sizing is not a one-size-fits-all formula for sure. It's a flexible tool that should be adjusted according to your account size, risk tolerance, and the specific characteristics of the trade you are entering. Okay, so guys, if you have any question, please just write it down through the chat box, and as soon as they arise, I will try to answer it as soon as possible. Thank you so much. Okay, as we transition to a practical illustration of the principles we've discussed, let's ground our understanding with a tangible example. I know it might be a bit confusing for many new traders, so it can be very helpful to show an example. As you see here, consider a scenario where we place a stop loss 50 pips away from our entry point. Let's say, first, let's ground our understanding with a tangible example. Imagine an account with a balance of $10,000. As astute risk managers, we will commit to a disciplined approach, risking a prudent 2% of our account size per trade only. So now consider a scenario where we place the stop loss 50 pips away from our entry point. So pips, as many of you will know, are the measure of movements in the forex market, and in this case represent a change of 0.005. So this is the stop loss in terms of pip. So with our rules firmly in place, we calculate the amount at risk 2% of our $10,000 account equates to $200. This figure represents the maximum loss we are prepared to absorb on this particular trade. Next, we determine our monetary position size by dividing our risk amount by the value of each pip. Here, $200 divided by 0.0050 gives us a monetary position size of $40,000. Lastly, we translate this amount as you see here. We translate this monetary figure into lots, which are the standard unit of trade in the forex market. Since one standard lot is typically worth 100,000 units of currency, our position size of 40,000 corresponds to 0.4 lots. This precise calculation underscores the importance of a methodical and analytical approach to risk management, ensuring that we are always aligned with the fundamental tenets of preservation of capital. I hope you found this helpful. Now it's time to deeply look at the crucial aspect of forex trading, the harmonious blend of trading strategies and risk management. Think of these two elements as the win engines. as the twin engines actually powering your trading journey, and each is essential but only in unison to they propel you towards enduring success. First, let's consider the trading strategy. It's your roadmap, your plan of attack. Whether you're a day trader riding the waves of daily fluctuations or a long-term trader cruising on broader market trends, your strategy dictates every move you make. It's about when to enter, when to exit, which currency pairs to trade, and at what times. Now overlay that with risk management. This isn't just a shield to guard your capital, it's a lens through which every aspect of your strategy should be viewed. It's about managing the risk inherent in your strategic choices, ensuring that each decision is weighted not just for potential profit, but for potential loss as well. So herein lies the interdependence between these two elements. A great trading strategy without sound risk management is akin to a high-performing vehicle with no brakes. It may offer exhilarating speeds, but it's dangerously incomplete. Conversely, risk management without an effective trading strategy is like having brakes. Yeah, but no direction. Safe, but going nowhere. So this brings us to the concept of trading expectancy. It's a metric that combines the elements of your strategy with your risk management. Think of it as a formula that predicts the potential success of your trading plan. It's not about the outcome of a single trade, but the average outcome of all your trades over time. So this when the diagram visually captures the synergy between trading strategy and risk management converging at trading expectancy. It's in this overlap that we find the true measure of a trader's acumen. In summary, the fusion of a well-crafted trading strategy with robust risk management is more than just a good practice. It's a requisite for sustainable profitability in forex trading. And as we move forward, understanding trading expectancy will become a key factor in assessing and refining your approach, ensuring that you're not just surviving the market's challenges, but thriving through them. Okay, all good. Guys, I really would appreciate if you give me some feedback and please just write me down a question that may arise as soon as possible. So I will get to there maybe right away or at the end of this session, at the end of the webinar. Thank you. Let's now turn our attention to trading expectancy, a vital metric in forex trading that forecasts the average profitability of your trades. It's the numerical expression of your trading strategy's effectiveness. Trading expectancy is calculated using the straightforward yet powerful formula, the difference between the product of your win rate and average win and the product of your loss rate and average loss, as you see here in this formula. This formula gives us a clear view of what to expect from our trading strategy over time. So let's dissect the components. Win rate is the percentage of your trades that are profitable, while average win is the average amount gained from these successful trades. Conversely, loss rate is the percentage of trades that incur losses, and average loss is the average amount lost in these trades. So consider a scenario with a high win rate. The example number one. and an average win of $100, juxtaposed with a 30% loss rate and an average loss of $150. The trading expectancy, as you see here, is calculated at $25 per trade. This scenario, despite a high win rate, shows only moderate profitability due to the lower average win. And in the example 2, let's look at a low win rate with higher rewards. Here, a 40% win rate with an average win of $200 and a 60% loss rate with an average loss of $100, resulting in trading expectancy of $20 per trade. And this example illustrates how a strategy can still be profitable. This example shows how a strategy can still be profitable even with lower win rates, and provided the wins are substantially larger than the losses. Now let's jump on the example 3. In a balanced scenario, with equal win and loss rates and amounts, say 50% for both rates and 150 for both average win and loss, the expectancy is 0. This indicates a break-even strategy where wins and losses offset each other. But lastly, we have example 4, as you see here, an unprofitable scenario, a 30% win rate with an average win of $100 and a 70% loss rate with an average loss of $200 results in a negative expectancy of minus 110 per trade. And this is a clear indicator that the strategy needs revisiting. So these examples visually compare these scenarios, demonstrating how the variations in win rates and average win losses impact trading expectancy. To sum up, trading expectancy is a critical tool for evaluating your forex trading strategy, and it is a positive expectancy suggests a potentially profitable approach, while a negative one signals the need for revision. Understanding and applying this concept is key to developing a successful trading strategy in the forex market. But let's shift our focus to a fundamental concept in forex trading, which is the risk to reward ratio. It's a simple yet powerful tool that helps traders evaluate the potential profitability of their trades relative to the risk they are taking. The risk to reward ratio compares the potential loss or risk of a trade to its potential profits or reward. It's typically expressed in terms like 1 to 2, where the risk is half the potential reward. In practice, or let's say in practical terms, this ratio guides you in setting your stop loss and take profit levels. For instance, if you enter a trade with a stop loss of 50 pips and a take profit of 100 pips, you're employing a 1 to 2 risk to reward ratio. And what constitutes a good ratio? This is a $1 million question, guy. It's not one size fits all. It depends on your trading style and the market volatility. Some traders prefer a 1 to 2 ratio, while others might aim for 1 to 3 or higher, seeking to maximize potential reward for the risk taken. Now, let's talk about the advantages and limitation. The primary advantage of using a risk to reward ratio is that it provides a systematic approach to risk management, and it helps in making informed decisions about trade entries and exits. However, the limitation lies in its isolation. A favorable ratio is not a guarantee of success. It doesn't account for the profitability of winning and losing, which are crucial factors in trading. We try to illustrate different risk to reward scenarios. Notice how the outcome of each trade varies based on the ratio applied. In conclusion, while a favorable risk to reward ratio can enhance trading expectancy, it must be carefully aligned with your overall trading strategy, particularly your win rate. It's not a standalone measure, but a part of a comprehensive trading approach. Employing this ratio effectively can lead to a more disciplined and potentially profitable trading experience in the Forex market. Now let's dive into a critical aspect of Forex trading, assessing and improving your trading strategy using the lens of trading expectancy. This approach is not just about tweaking your strategy, it's also about fundamentally understanding and enhancing its profitability. So, assess a trading strategy using expectancies like taking an X-ray of your trading performance. It reveals the underlying health of your strategy, showing you not just where you're winning or losing, but how these wins and losses balance out over time. Improving your strategy, therefore, is about making adjustments that positively influence your expectancy. And this could mean refining your entry and exit points, adjusting your stop loss levels, or easily recalibrating your position sizes. So consider a consistently losing strategy. Let's look at the first example here. Low win rates with a small average wins and larger average losses. The negative expectancy here is a clear indicator that something's amiss. To improve, you might need to tighten your stop losses or revisit your entry criteria, or improve your risk to reward ratio to avoid frequent small losses. Now let's look at the example 2 here, break-even strategy. A moderate win rate, but wins and losses almost balance each other out. Here expectancy hovers around 0. Improvements can include strategies to increase the size of wins, perhaps by optimizing exit points or letting winning positions run longer. And now, then there is the high risk, high reward scenario in example 3. A high win rate with large average wins, but also significant losses. Despite a high positive expectancy, the risk level might be unsustainable. Here, the focus should be on implementing more stringent risk management to protect against those large losses. But finally, consider a low frequency, high reward strategy, a low win rate, but with wins significantly larger than losses. The positive expectancy indicates potential profitability, but the infrequent wins demand robust risk tolerance and careful capital allocation. To improve, you can ensure that a robust risk tolerance and capital allocation to withstand infrequent but large gains. So these comparative examples show how different strategic adjustments impact trading expectancy, highlighting the need for a balanced approach that maybe weighs both risk and reward. In a sense, trading expectancy provides a quantitative foundation to assess and refine your trading strategy. So it's about making calculated adjustments, focusing on enhancing your win rate, increasing your average wins, or reducing your average losses, all while maintaining a balanced approach. This prioritizes long-term success in the Forex market. Okay, guys, now this is the time for our question and answers. Please write down your question. If you have any, then I will answer them shortly. Okay. Okay, here is a question. Uh, Mr. John asks, how many trades we need to start calculating the expectancy? I would say depends, but let's say you can start to just categorize your win rate, the average win, your loss rate, and average loss. But after maybe 10, 15 trades, I usually advise all of my students to do that as soon as they get some reasonable results, or they build, let's say, uh, a reasonable number of trades. So the better, the sooner, of course, the better. Yes, about the appropriate position sizing. Uh, my friend asks if it's a practical formula and how we can do that for any trade during the day. Guys, there are many helpful right now guides and let's say tools out there on the internet. You can find a calculator for risk management, or there is some expert advisors, or let's say they work like an indicator somehow. So here is a very good question. How does leverage affect risk in forex trading? As we explained earlier, leverage in forex trading amplifies both potential profits and potential losses. While it allows traders to control large positions with a relatively small amount of capital, it also increases the risk of substantial losses, sometimes exceeding the initial investments. Therefore, it's essential to use leverage with caution. And of course, you see, when you use the leverage, you may just eh, amplify the risk of your account. Yes, guys, and I can stand out if you have any more question. Yes, Mr. Abdullah, I see you're writing down. No problem, take your time. Okay, we have a question about the diversification. The question is how the correlated currency pairs affect risk management. I would say correlated currency pairs can significantly affect risk management as they move in tandem or opposite to each other to a degree, which can inadvertently increase overall exposure. For instance, if a trader takes long positions in two positively correlated pairs, a movement against one is likely to affect the other and effectively doubling the risk. So managing this requires monitoring correlation and coefficients and adjusting position sizes or using hedging strategies to mitigate risk. That's why I always advise the new buy and new traders that please don't open more than one or two position at the time, because first you need really to master the calculation and to understand the function and relationship between the events and also the trading instruments. Doesn't matter is in which asset classes. It can be currency pairs, can be commodity or anything else, but it's really vital to understand the relationship between these assets before jumping on the trade and open many questions at the time. So that's why I always ask them, my students, to stop opening or trying to manage too many positions at the time. And here is our last question. What is the role of value at risk or VAR in forex risk management? Okay, that's a very great question. I would say value at risk or VAR is a statistical technique used to measure and quantify the level of financial risk within a portfolio or a specific time frame. In forex, VAR gives traders an estimates of the probability of a certain loss or worse within a given time period. So this can help in making informed decisions about trade sizes and stop loss values, ensuring that the potential losses are within the trader's risk tolerance level. So that's how you can use it. And here is another question about the Kelly criterion. And the question is, how can traders use the Kelly criterion in managing forex trading risk or criterion? The Kelly criterion is a mathematical formula, guys. It is used to determine the optimal size of a series of bets. In forex trading, it can be used to calculate the ideal amount of capital to be allocated to a trade based on the probability of the trade's success and the trader's past performance. And this method aims to maximize capital growth while minimizing the risk of ruin, but it requires precise estimation of one's win rate and the win to loss ratio. So I would suggest not using this till you find yourself a master of trade in forex. That's great. That's great. Guys, there are some other questions. I appreciate if you can just send them towards my email, as I'm going to write down my email here. I appreciate if you send me your send to my email your question, because we are running out of time, and unfortunately I'm not able to continue the session further. Thank you so much, by the way. Thank you so much for staying with me. In the upcoming weeks, we will have much more webinars about the trading strategy, technical analysis, and fundamental analysis. So please make sure to stay tuned with us by following the webinar page on our website, aroundit.com. Thank you so much, and have a great evening. Thank you. Bye-bye.